review our lecture notes. So after the equity chapter, we talk about bond, right? So the starting point of understanding bond is to understand these very basic definitions, such as face value or par value. This one should be easy, right? As long as you have taken a course in the corporate finance, then you would know what is the face value. Basically, face value is the value or the money you're expected to get back on the maturity date. And then coupon rate. So coupon rate, basically it is a percentage you can get maybe annually or semi-annually. And maturity date. So it is a date on which you will get your par value back. Bond yield. So to understand bond yield, it's actually useful to think about this bond pricing formula, right? What you can see here is bond yield is essentially a discount factor, right, which is used to discount the par value and each coupon payments. This pricing formula is obviously important. If you conjecture, if you guess what will appear in the final exam, then you can see that this bond pricing formula will definitely appear in your final exam, right? Because I said, hey, most problems will be about doing some calculations. And then if there is a formula, then you will know that, okay, most likely there will be a problem about this formula because, well, you have to use a formula to do calculation, right? Bond pricing formula is kind of hard if you have a lot of periods. So basically in a final exam, you're not required to use calculator. Or I would say even without a financial calculator, just use this plain bond pricing formula. You should be able to find out its price. So generally you should only expect 2 or 3 periods. Okay, about using bond pricing formula, there are basically 2 major applications, right? So basically you can see that first, you can use the bond pricing formula to find the price of the bond. Or given the price of the bond, you can find out what is the bond yield, right? But you can see that you can actually extend this argument. Basically, you can see that if you tell me price, if you tell me coupon, if you tell me this bond yield, I can tell you par value, right? Or if you tell me par value, the bond yield, and the price of the bond, then I can tell you coupon rate, right? Okay. Next, we discussed the bond risks. This is a big topic, right? There are basically 2 major sources of risk. The first is due to the possibility of default, and the second is due to the change in the interest rate. And you can see that the harder part is about this interest rate risk, right? Because if you recall what we discussed in the chapter, we actually spent, I guess, about 10 minutes about default risk. So you can imagine that in the final, there gotta be some problems about interest rate risk. So first, the basic understanding of the interest risk is you have to understand it has 2 components. The first component is price risk. That is, the bond price will change if the interest rate changes. To be more specific, if bond yield increases, bond price will decrease, right? So this is a price risk. And then you have the reinvestment risk. This is related to the coupon payments. It says that for each coupon payment, you have to reinvest it. And after getting your coupon payment, there is some uncertainty in what kind of interest rate you can invest, right? And you can see that price risk and reinvestment risk, they're at the opposite directions. What I'm saying here is if bond yield increases, then bond price decreases. However, the reinvestment return from reinvesting your coupon payments actually increases, right? So you can see that they can actually offset with each other. And this kind of offsetting result is actually the reason why we can use the so-called immunization, right? So, okay, maybe I should not talk about immunization now. So let's continue to talk about interest rate risk. There's a page in the lecture note which talks about several rules about how bond price changes with the yield. And you can see that I'm writing down these rules here, such as bond price and yields are inversely related. Well, you have to know this, right? And then there are some other more complicated rules, such as a increase in a bond yield result in a smaller price change than the decrease in bond of equal magnitude. You don't need to memorize these rules. The requirement here is as long as you can understand these rules, then that is fine. And then to better quantify or to better measure interest rate risk, we talk about or we defined duration, right? So duration is like a more accurate measure of maturity, or you could call it a effective measure of bond maturity. Basically, it's a weighted average of different cash flows paid by the bond, right? And you can see that, as I said, it's a weighted average. And these T's basically refer to the time you can get your coupon payments and your final par value. And then the weight is given by the present value of the cash flow on the T divided by the bond price. And then after defining duration, we can define modified duration. So this definition is simple. It's basically duration divided by 1 plus yield. And then importantly, we can calculate how bond price will respond to the changes in the bond yield, right? So what you can see here is we can get a approximate measurement on the change of bond price. This one is essentially percentage change, right? So this is the percentage change in bond price. And this is the change in the yield. So obviously you can see that as yield increases, bond price decreases. And then we also learned about convexity. The reason we want to talk about convexity is this one is really a approximation. And it's a approximation because bond has some convexity here, right? So if you look at this picture here, let's say this is the bond price, this is the yield. Convexity basically refers to a shape of the curve looking like this. And then let's say if y is here, and you want to think if y increases, how the bond price will change, right? So essentially, you can see that the bond price change will be approximated by this straight line. So it shows that if the yield change is large, then the approximation will generate some approximation error, right? So this distance gives you the approximation error due to convexity. So in a word, We talk about convexity because we want to get a more accurate calculation on how bound price changes if yield changes. Essentially, the second formula, this guy, is a more accurate approximation. As I said, you're not required to understand how to exactly calculate convexity. If there's a problem about using this formula with convexity, I will tell you what is the value of convexity. And then we talk about a very important application, which is to use immunization to manage interest risk. So it's really a risk management technique. The trick of the immunization technique is you want to match the duration of the asset with your liability, right? Think about a pension fund. If you have a liability in the future, then the present value of this liability will change if the interest rate changes. So to manage this kind of risk, you can use the immunization technique. To be more specific, you will just match the duration of the asset with the liability. And the beauty of this matching technique is when you match the duration here, the price risk and the reinvestment risk will exactly cancel out, right? So this basically means that the asset will be almost free of interest rate risk. I'm using almost here because there is also this convexity issue, which will actually affect how you can immunize your bond portfolio from this interest rate risk. There are two comments here. First, for a portfolio of asset, the duration of the portfolio equals the weighted average durations of individual assets, right? You guys have seen this in your lecture note problem. I can't remember it exactly, but basically we discussed a pension fund, and this pension fund tried to use immunization to manage interest rate risk. And in that case, the pension fund actually has two kinds of assets. The first, I think it's a zero coupon bond, and the second is a perpetuity. And in that example, you can see that the duration of this portfolio equals the weighted average duration of the bond, equals the weighted average duration of the perpetuity and the zero coupon bond. And the second comment is, as time passes, your duration will change. So you will need to rebalance your portfolio. Basically, for these two comments, you can actually look at the lecture note problems and you will understand what I'm trying to say here. And you can imagine that immunization is an important part, right? So you should pay some attention to this part. Okay, second, options. First, basic definitions. So you have to understand what is a call, what is a put, what is the expiration date, and what is the exercise or strike price, what is the option premium. And you also need to understand moneyless. That is, a option can be categorized as in the money, out of the money, at the money, right? So I'm using some shortcut here. And you also need to understand how to calculate option payoffs. When we're talking about option payoffs, you have to know that you have different formulas depending on whether you have a call option or a put option. And then in this section on these basic definitions, I discussed this index linked CD. And I think this is a very interesting application. Remember the basic idea is you wanted to build a portfolio which can guarantee you some kind of return, and at the same time you can also get some exposure to the market return. So the process to build this portfolio is actually very simple. You will first calculate how much money you want to invest in this risk-free asset, because using risk-free asset will give you the guaranteed return. And then you will have some residual money left. So you will use this residual money to invest in a call option, which is based on the market index. So this will give you market exposure. As to how you can exactly determine how much money to invest in the risk-free asset and the call option, then you can check the lecture note. And then we also talk about this put-call parity theorem in European options. It's a pretty important result. And if you want to if you want to study further on options, then this put-call parity really plays an important role to help you understand a lot of things. And if you go even further to read some papers, and you can see that a lot of papers will actually talk about this put-call parities. So the idea about this put-call parity is really about two kinds of portfolios, right? Remember the process of proving put-call parity. So we said there are two kinds of portfolios. The first one is put plus stock. The second one is call plus bond, right? And then we said these two portfolios will give you the same payoff. So they should have the same present value. This will give you the put-call parity without dividend. And if we are thinking about the case with dividend, then what you can see here is we have the minus PVD on this left-hand side. So in the end, you will get a formula exactly as this one. Oh, by the way, you can imagine that if this put-call parity is violated, then there should be some arbitrage opportunities. And you can see that in this class when we're talking about derivatives such as options and features, we have calculated a lot of arbitrage opportunities, right? The basic idea here is whenever a model is violated, then you will want to short sell the expensive assets, and then you want to buy the underpriced assets, and then you will show that you can actually get some positive even if your initial investment was actually zero. So this is the arbitrage profit. Again, I know it sounds actually kind of confusing when I'm just talking about these arbitrage profits. The best way to learn about these arbitrage strategies or arbitrage profits is to look at the lecture note and homework problems and try to solve them yourselves. And then we talk about the very important option valuation. So if you go to advanced courses on options, then option valuation really plays a huge part. So first, we talk about some general rules on option values. Obviously, you have to first understand what is the definition of intrinsic value and time value, right? So basically, you can decompose option value into intrinsic value and time value. And intrinsic value is the value you can get if you immediately exercise your option. And then time value is the difference between the option value and the intrinsic value. And why do we have time value? Well, because your option still has some time left before this expiration date. And then because there is time left, then there are some possible or in the future, some good events could possibly happen. So this will actually give your option some value, and this is time value. And we also talk about value bounds, that is the upper bound and the lower bound for call and put options. And if you look at the lecture notes, it's actually based on a very simple argument, and it is also based on the put call parity theorem, right? So it's important for you to understand how to get these bounds by using put call parity theorem. And then formally, we talk about three kinds of option valuation models. The first one is binomial model. The second one is the Black-Scholes model. And the third one is the risk-neutral model. I would say Black-Scholes model is actually somewhat easy, because what you actually need to do here is, for Black-Scholes model, is you need to understand how to plug in numbers, right? So as long as you know how to plug in numbers, then I believe you can solve the call or put value from this Black-Scholes model. But for binomial pricing model and this risk-neutral model, you have to have some understanding what we're doing here, right? So for binomial model, basically we're trying to assume the stock price has only two values for a single period, right? Such as if today's price is 50, tomorrow is 80 or 40. And then based on this assumption, we can use two kinds of approaches to find out the value of a call option. That is replication approach and hedging approach. Replication basically means you will replicate the payoff of the call option using stock and bond. And because you can replicate the call option's payoff, it means the price of the option should be equal to the present value of this replication portfolio. So this will give you a pricing formula. And then the second approach is hedging approach. Clearly you can see that in this class we talk about hedging a lot. So you can see that the hedging approach here is actually pretty important. The idea of hedging is you will build a hedging portfolio. That is, you will have a long position in the stock, and you will have a short position in the call. And then you want to show that because it's a hedging portfolio, this implies that the value of this portfolio should be fixed. So you will want to find out, for let's say for one stock, how many number of call options you want to sell to build this hedging portfolio. And then you will get the value of this hedging portfolio, and you will discount the value of this hedging portfolio using risk-free rate. So this will give you an idea in how to calculate the call options price. Again, to understand these two approaches, the best way is to to look at the lecture note problems. Obviously, I have limited time, so I cannot solve these problems for a second time. And then the third approach is the risk neutral pricing model. So the idea is you will just assume you're having a risk neutral world. Everybody will discount every asset using the risk-free rate. However, this is not realistic, so you will want to adjust the probabilities. This adjusted probability is called risk-neutral probability. To be more specific, in actually how to apply this model, you'll actually first use the share prices to solve the risk-neutral probabilities. And then you will use the risk-neutral probabilities to calculate the expected return of the call option. And then you will discount this expected return with a risk-free rate. This will give you the price of the call. Again, please read the lecture note. There are so for all these option valuations, we have generally two applications. The first is about hedging, right? The first step to solve a hedging problem is to calculate the hedging ratio. To put it simply, hedging ratio is a ratio of value changes between one asset versus another asset. For example, if you're having a long position in equity and you have a short position in call, then the hedging ratio is essentially the value change in call divided by the value change in equity. So it's always about the ratio of changes of two different assets, right? And then the second application is arbitrage. The basic idea about arbitrage is whenever a pricing formula or a pricing model is violated, then theoretically there will be arbitrage opportunities. And to build this arbitrage portfolio, you will short sell overpriced asset and you will buy underpriced asset. And then you will try to adjust your initial position such that your initial position is actually zero. And then you want to show that out of this zero position, you can actually get some positive payoff. So based on this result, you can say there is some arbitrage profit. Again, I know when I'm saying these processes, it actually sounds confusing. I just want to remind you that look at those lecture note problems. And then we talk about futures. Futures is another derivative. And again, you have to understand these basic concepts. That is, what is a future price? What is a spot price? What is the payoff to long and short futures positions? And you also need to understand the notion of marking to market and how to calculate it, right? And then there are two kinds of applications in futures. You could speculate or you could hedge. And then we talk about several theorems. The first one is a theorem which tells you how future price and current spot price are related, right? This is the so-called spot futures parity theorem. And to understand this theorem, we actually have two methods. The first is the hedging method. That is, you will build a hedging portfolio, and using this hedging portfolio, you can show that the spot futures parity theorem actually holds. And then we have this cost of carry approach. Basically, you will compare two approaches to obtain your asset. The first approach is you will actually want to buy it and you will want to carry it. Or you could buy it in the future. And in a market without arbitrage, these two approaches should give you the same payoff, right? So based on this, you can find out the spot futures parity theorem. And then we talk about two extensions based on this spot futures parity theorem. Remember that the spot parity theorem okay, let me recall what is the formula here. I think it's F0 S plus, okay, let me use P here. So P0 plus P0 RF minus D. So this is the spot futures parity theorem for futures on equity. So here you can see that this is today's equity price. This is the loss of interest payment if you invest P0 into equity. And this is the dividend you can get, and it will offset your cost. So you want to use a minus sign here. And then these two ways of obtaining your equity should give you the same results. So you have a equality sign here. And then there are two extensions. The first extension is about extending this model into multiple periods, right? So if we further write this into 1 plus RF minus D, then this is just a 1 period model. For 2 period model, we just use this squared here. Of course, you can extend this model into 3 periods or 4 periods. And then we also discussed how this future prices are related. So basically you can see that F0 equals P0 1 plus RF minus D. So let's say this is F2, so this equals 2. Then F3 would be P0 1 plus RF minus D 3, right? So this tells you F3 equals F2 1 plus RF minus D, right? So this result basically tells you how futures prices at different times are related. And spot futures parity theorem tells us how future price and current spot price are related. And we also talk about how future price and expected spot price are related. So this is about the second result. The first result is about this. The second is about this. There are basically 4 hypotheses to tell us how future price and expected spot price are related. The first is called expectation hypothesis. It basically means that the expected spot price should be exactly the same as the futures price. And then we have 2 important concepts. The first is called backwardation. The second one is called contango. Backwardation basically means that sellers are hedgers. So if sellers are hedgers, then they will be willing to sell at a lower price. In this case, F0, that is the future price, will be smaller than the expected spot price. And then contango means buyers are hedgers. In this time, buyers, because they wanted to hedge against the market risk, they will want to bid up the future price, which means future price will be larger compared with the expected spot price. And it's also important for you to understand the pictures, right? So we know that if there is backwardation, let's say this is the so let's say this is the maturity date.
I'm having trouble hearing you.
Oops, sorry. The Apple Watch is crazy here. So let's say this is the maturity date or the delivery date. Then let's say this is expectation of the future spot price. Now what you can see here is if we have backwardation, then in the beginning this future price will be lower. However, as the futures approach maturity, then the futures price should be the same as the expected spot price, right? Because we have learned the convergence property. That is, on the delivery date, the futures price should be the same as the spot price. So this is the case of backwardation. And then this is the case of contango. And then the fourth theory is about using this modern portfolio theory to find out how the future price and expected spot price are related. The idea here is very simple, right? So basically it says that if you buy at future price, then it is risk. It is riskless. So you should discount this F0 by risk-free rate. And if you buy at, or if you buy using this future spot price EPT, then there is risk. So you should discount this number with 1 plus K. Here K is a cost of capital solved by CAPM, right? And then you will get this result. And then we go into details, talking about 3 kinds of futures. The first is the foreign exchange futures. And here we learned interest rate parity theorem. It's really just a modified version of the spot futures theorem. However, it is very specific to the exchange futures market. So basically the idea here is, so here E0 means the exchange rate, right? Such as E0 dollars per pound. That is, if you want to buy 1 pound, then you have to pay E0 dollars. And you can see here that to understand the interest rate parity theorem, it's actually pretty easy. You can use the following argument. So let's say if I have 1 pound, right? If I have 1 pound, then I can exchange it into E0 dollars. And then I will invest, right? I will invest this in the US market. So this will become E0 1 plus RST, right? Because RS is basically the interest rate in the US market. And then I will actually convert this money back into pound. So I would use this amount. I will use this amount and divided by the future by the futures price F0. So this will tell me how many pounds I will have in the future. And then the second way to do this, I will just directly invest this £1 in the UK, and after T periods, I will get 1 plus RUKT, right? And these two ways of strategies should give you the same payoff. So they should be the same, right? That's how you get this interest rate parity theorem. And then in terms of application, it's the covered interest arbitrage and hedging currency risk using the interest rate parity theorem. So again, please look at the lecture note problems. And then we talk about stock index futures. Again, two applications. Synthetic equity position or hedging against market risk. This first one is actually pretty easy to understand, right? Because it basically says you can replicate your equity position using index futures. And then in terms of hedging, it's really about beta hedging. That is, to calculate the hedge ratio, you have to know the beta of your equity position. And then we talk about interest rate futures and this swaps. Again, there's a hedging problem in the lecture note, so make sure you understand it. And there is also this pricing formula. The idea about this pricing formula is you can replicate the so-called swaps using two futures. So on the left hand side, you're using two futures, 1 and 2, to replicate this 2-period swaps. And this F star is the price of this swap. And these left hand side and right hand side should be the same. So you get this formula here. And last, we talk about commodity pricing. There are basically two cases here. The first case is pretty simple. It's the commodity which can be stored. In this case, we just use this spot futures parity theorem. The only caveat here is this C has storage cost. And there are also some commodities which cannot be stored or you don't want to store it. In this case, we will use the modern portfolio theory to find out how the futures price is related to the expected spot price. And then we talk about performance evaluation. First, or on a very basic level, you have to know how to calculate different kinds of returns. So we talk about annualized return, or the fancier name, effective annual return, right? And we also talk about this very basic kind of return, that is holding period return. And then we talk about annual percent rate. And we also talk about a more complicated version of the annual percent rate, that is the continuously compounded return. So clearly, given holding period return, you need to able to solve the effective annual rate and annual percent rate. And given annual percent rate, you need to be able to solve effective annual rate. So similarly, given effective annual rate you should be able to solve the annual percent rate. And then we talk about average returns. So there are basically two kinds of average returns, right? The first one is like the normal one, right? So basically, if you tell me there's R1 and R2, then this arithmetic average is given by this. And then we also have this geometric average. In this case, you will use the multiplication to find out the geometric average return. And then the internal rate of return, which is also called dollar weighted average return. And you have a homework which specifically talks about this. So you should be able to solve these all kinds of returns. And then we talk about several performance measures such as Sharpe ratio, M-squared measure, and trinomial ratio, and information ratio. The requirement on these performance measures are not high. So as long as you can know how to calculate these measures, right? So for example, if you have solved this RP and then you have RF and you also have this volatility, then you should be able to understand how to find out Sharpe ratio. And then we talk about several more complicated evaluation techniques. The first one is called style analysis. So what you're doing is you decompose your portfolio's return into the returns of different style portfolios. This is a decomposing technique, right? So essentially you can see that you can call this part as style returns. It's actually a bad name. Maybe a better name is returns due to exposure to style portfolios. But let's just make it simple. Call this as style return. And then this is the return due to asset allocation or security selection. And then we talk about how do you evaluate the market timing ability. So this is a quite interesting process, right? So first, what is market timing? Well, to put it simply, market timing basically means you want to invest in the right asset at the right time, right? So if you think tomorrow the equity market will be positive, then maybe you would want to invest in the equity market. If you think in the next year the market return will be negative, then maybe you will just stay in cash, right? So this is a type of market timing. So we talk about two kinds of process to find out whether a particular manager has this market timing ability. Under these both cases, as long as the C is positive, then you will know that this manager has market timing ability. For this section on evaluating market timing ability, you're not required to solve A and B and C. You're just required to understand how to interpret the result. So if I tell you that C is 0, then you should be able to figure out this manager has no market timing ability, right? And then we talk about performance attribution. This one is important right? So you should make sure you understand it. And it's actually very easy, and I think it's very intuitive. So basically, you will compare your portfolio with a bogey portfolio. This bogey portfolio is really a fancy name for a benchmark portfolio. So you will first look at the return differences in the portfolio and the bogey portfolio. And then you will try to decompose this return difference into two components. Right? The first component is the contribution from asset allocation. And the second component is the contribution from security selection. And you can see the formula here, right? So basically, when you're thinking about how to calculate the contribution from asset allocation, you will fix the return at the benchmark return or the bogey portfolio return. And then you will look at the weight or portfolio weight differences in the two portfolios. This is very intuitive, right? Because you know that you're thinking about allocation. Allocation means you're having a different portfolio weight. And the second component is about security selection. In this case, you will fix the portfolio weight and then you will look at return differences. And then you can see that if you're fixing the portfolio weight, then the return difference will come from security selections, right? So this is performance attribution is essentially a decomposition technique. Try to understand where does the performance come from. And the last chapter is on portfolio optimization. This chapter is actually pretty simple because I did not have enough time to go into more details. We basically talk about two sections. The first section is about capital allocation. And there are basically, the idea here is very simple, right? You will look at this capital allocation line. That is, the line connect the risk-free rate and the risky portfolio. And then you will ask, what is the optimal allocation? That is, should I invest 20% in P or 30% in P? And by introducing utility function, you can find the optimal choice of allocation is given by this formula. And then we talk about the Markowitz portfolio optimization. So basically, we want to focus on a very simple case. That is, you have two risky assets and you have one risk-free asset. And then to understand the optimal allocation, we have three steps. The first step is the mean variance frontier. That is, if you tell me the data on the equity, right? So we basically have two assets here, debt and equity. So if you have the return and the volatility and the correlation between debt and equity, then you will be able to find out this mean variance frontier. So this is essentially the first step. And then you will think about the optimal risky portfolio. Graphically, this means given the risk-free asset, you will look for the line which maximizes the Sharpe ratio. Right? So this will give you portfolio P, which is the which is the optimal risky portfolio. And you can see that the textbook gives you the formula for the optimal risky portfolio. So you need to be able to understand how to plug in numbers to find out the optimal weights. And then you have this optimal allocation. That is this part, right? So optimal allocation is really about capital allocation. So after getting this optimal risky portfolio P, now you could use this formula to solve how much you will want to allocate into P versus how much you will want to allocate into this risk-free asset F. And I said the exam on this chapter will have the similar difficulty as the lecture note problem. You can see that I would say this one is the most important problem. So make sure you understand how this actually works. Okay,